Hello and welcome to Session 5 of the Basic Tax course. We're going to begin Session 5 with a review of the Session 3 quiz answer key. I have the Session 3 quiz up on the screen in front of you, and the first thing you may have noticed with the Session 3 quiz is that it was a heck of a lot easier than the first two quizzes in this series. And this is because some of the concepts surrounding filing requirements, filing status, and dependence are a heck of a lot more rule-oriented and exception to the rule-oriented than straight income and expense items. Expense items and income items tend to be a little bit more straightforward, but of course there's still plenty to learn about the rules. So with today's quiz review, that is the Session 3 quiz review, we're not going to actually review very many questions because in general most students just don't have a hard enough time with this quiz to really warrant too much time being spent on it. I'm going to review a few of the problems, and any other questions you have, please review to the quiz answer key for Session 3. If after reviewing the Session 3 quiz answer key you have questions that are unanswered, then you would go, of course, to the Q&A forum and post a question. So let's begin with the first of the most frequently missed questions from the Session 3 quiz, and we will see that the first question in line involves Mr. G in question number 1. Mr. G worked at Zippy Restaurant and received $30 in tips for 1 month. That same month, he also worked at Eater's Restaurant and earned $15 in tips. Mr. G must report his tips to both of his employers. The answer to this question is false, and I have a little note here just to explain why. Tips only need to be reported from Zippy Restaurant, and that's because Zippy Restaurant is the only restaurant where Mr. G received more than $20 of tips during the month, or actually $20 or more of tips during the 1 month. And tips of less than $20 in any 1 month from any one employer do not have to be reported to that employer. However, the tip income in total, all 30 plus 15, which would be $45, does need to get reported as wage income on Mr. G's return. Next question in line is question number 2. Tip income is always includable in gross income, even if the amount received is less than $20 per month, and that is true. Again, I wanted to focus your attention on a key concept, so let me open up. So let's just take a look at Form 1040 so I can clarify for you what it is I'm referring to. Tip income is a form of wage income. It's a form of earned income. And whether you receive $1 of tip, $2 of tips, or $2,000 of tips in any 1 month or for the whole year, that income is taxable, and it's taxed as wage income. It goes on line 7 of the Form 1040. Now, in addition to being taxed as wage income, you might have to pay more than just income tax on your tips. And you have to pay more than income tax when you are subjected to the tip tax and did not report your tips to your employer as you were required to. So if you have a month where you are required to report tips to your employer and you do not report those tips, that is a month where you're going to have to complete Form 4137 to calculate the tip tax. Now, you're supposed to keep a tip log and record your tips as you receive them on a daily basis. If you get to the end of the year and you have this tip log and your employer allocates tips to you, you can go with the allocation amount or the tip log amount if you have a tip log amount that can prove a lesser amount. Either way, you're going to report tips as wage income. If you reported your tips to your employer has already put them on your W-2 and has already withheld Social Security and Medicare tax on them. If you did not report your tips to your employer and the amount of tips you received from that employer in any 1 month exceeds $20, then that tip income is also subjected to the Social Security and Medicare tax for the employee's half of the tip income, or the employee's share of those taxes. So in a month where you were required to report tips and did not, that is a month where you're going to have to prepare Form 4137 to figure the amount of tax you owe on that tip income that was not reported. So in the case of Mr. G, if Mr. G reports tip income as he is supposed to both of his employers, then he will not prepare Form 4137. He will get a W-2. The W-2 will show the tip income is included with the wage income, and he'll just use the W-2 to report that income on line 7. But if Mr. G receives tips that he does not report, even because he's not required to, such as the Eaters restaurant, that same month he works for Eaters and he doesn't report the 15 because he's not required to, then what's going to happen is he's going to have to add $15 to line 7. The W-2 won't show the 15 because he didn't report it, so he'll include it on line 7. Now, let's suppose Mr. G did not report the 30 and he did not report the 15. Well, he's going to have to prepare Form 4137, and on it he will report $30 of tip income subjected to the tip tax. On line 7, he will report $45 of income because $45 is the total amount of tip income that he has to pay income tax on. But he only has to pay the tip tax on tips received in any month from any one employer that are $20 or more. So tip income in number 2 is always includable in gross income, even if the amount received is less than 20. But tip income is only subjected to the tip tax, that additional tax that is reported on Form 4137 and entered on line 57 of the Form 1040, when the tip exceeds $19 or is $20 or more in any one month from any one employer. So Mr. G, if he does not report tips, will report $30 of tip income on Form 4137. He will figure his tip tax and enter the tip tax on line 57. In the case of number 2, assuming you report all of your tips to your employer, all of those tips get included on your W-2 as wage income. If you're not required to report tips to your employer because they were less than $20 during any one month, then you still need to bump up your wages to include that tip income in your income. A long-winded explanation, but hopefully it's helped clarify some of that for you. We don't have any more questions until we get down to question number 8. Question number 8 reads, U.S. savings bond interest is taxable on the federal return. Now, U.S. bond interest is of course reported on Form 1099 INT in Box 3. Box 3 is reportable on the Form 1040. Let's just go over to 1040. And if you received U.S. bond interest, you would report that U.S. bond interest in full on line 8A of your federal return. If you receive U.S. bond interest, it is not taxable on the state return. However, we're talking about 1040, and if we're talking about 1040, U.S. bond interest is taxed in full on Form 1040. The other option here of U.S. bond interest is taxable on the state return, that's actually false. States are not allowed to tax U.S. bond interest. U.S. bond interest is taxed on both federal and state. That is also false because it's not taxed on the state. And finally, are not taxable by federal or state is false because U.S. bond interest is taxed on the federal return. Session 5, password number 1 is tobiano, T-O-B-I-A-N-O. We move down to the mini problem before we have any more problems. Mini problems are an excellent way to see if you're really grasping some of the concepts that we're discussing when it comes to filling out tax forms during a lecture. And of course, the key focal form of the lecture on wage and tip income was Form 4137, and so that's why we chose Form 4137 as a focal point for this mini problem. Neelix weighted tables at the Planet Earth Alliance for all of 2011. He had no other sources of income for the year, and he did not keep a tip log, naughty. Planet Earth Alliance issued Neelix the following W-2, prepare Form 4137 for Neelix, and answer the following questions. Well, this is pretty much a repeat of at least 2 preceding examples that we've given you in our classwork and homework assignments for Form 4137, so you should have had the hang of it by now. In Box 1, we see there's $28,000 of wage income, and down in Box 8, we see there is $5,000 of allocated tip income. And since Neelix did not keep a tip log, he's going to have to bump his wage income up from $28,000 to $33,000. And on Form 4137, he's going to have to show that he received $18,000 of reported tips and $5,000 of unreported tips for total tips received for the year of $23,000. So let's go take a look at Form 4137 answer key for Neelix. Okay, I have up on the screen in front of you now the answer key for Neelix. That is his Form 4137, fully prepared. We begin on line 1A by entering the name of his employer, which is Planet Earth Alliance. You can see we pulled that off his W-2. We enter the employer identification number, and we enter the total cash and charge tips that were received during the year. And I already told you we were going to take the 18 plus the 5, totaling $23,000 to enter on Form 4137 as their starting point. The next column asks how much was actually reported to the employer. Well, that's the amount showing in box 7. Those Social Security tips were reported. So how much tip tax does Neelix need to pay? Well, he's going to need to calculate his tip tax based on the $5,000 of allocated tips. So we finish filling out the form by doing the math and getting to a point where we show $5,000 is the amount of tip that income that he will have to pay tax on. We also show on line 7 the amount of income he must earn before he doesn't have to pay tip tax, and he is well below that threshold amount. All $5,000 is therefore subjected to the tip tax. We take 5,000, multiply that by 0.042, we get 210. We multiply 5,000 by 0.0145, and we get 73. And the final result is $283. Okay, so that concludes the review of the Session 3 quiz answer key. Let's move on now to the Session 4 manual for a review of the Session 4 homework assignment. And I have up on the screen in front of you now the Session 4 manual. We're beginning Session 5 with a review of the Session 4 homework assignment. And of course, the Session 4 homework assignment was incorporating all kinds of things. Really, we're asking you to look at information that we provided you in Sessions 1, 2, 3, and 4 and apply the knowledge you learned in those sessions towards preparing the Session 4 homework assignment. We begin at the top with the filing status of Sally Price. Sally is maintaining a household for a qualifying person who is related to her, her niece. Since her niece lived with her for more than half the year, she is also going to be able to claim that niece as dependent for purposes of the child tax credit. So we're going to enter the filing status of Sally as number 4 on the Form 1040, head of household. We will list her niece as a dependent, and we will also check the child tax credit box. The niece is less than 17 years old, lived with Sally for more than half the year, meets all of the other tests, and is eligible for that particular credit. We have 1, 2 exemptions, and the next thing in line is to enter the amount of wage income on line 7. So we go back to the Session 4 manual, find the W-2 for Sally. We see that she has $35,000 of income, and that should have been an easy number for you to carry over and enter on line 7. Going back up to the rest of the wording in the problem, we also have wording here that says that Sally received $500 per month of alimony. Alimony is taxable, and 500 times 12 is $6,000. So we go over to line 11 of the Form 1040 for Sally and enter $6,000 of income. The next item we come to in line is jury pay. Jury pay is fully taxable, and as we explained in Session 4, jury pay is an other income item that is entered on line 21 of the Form 1040. We carry the line 21 income over and total it up at $30. We also have $15 of interest that Sally earned on her savings account, and normally we could just slap that straight on line 8A. However, Sally did receive more than $15 of interest, and she also received more than $1,500 of interest, so we're going to need to prepare a Schedule B for Sally. Let's go take a look at that. So on the right-hand side of your screen, we're looking at Sally Price's K-1 that she received from ABC Investment Group. We can see that the K-1 is reporting a variety of different types of income. On line 2, it's reporting $1,500 of net rental income. On line 8, on line 5, it's reporting $1,500 of interest income, and on line 6A, it's reporting $100 of dividend income. So we know that since we've got $1,500 on line 5 plus $15 of other interest earned on her savings account, we're going to need to prepare a Schedule B. On Schedule B, we enter the payors of that interest. The first payor is ABC Investment Group at $1,500. Then we've listed XYZ Bank at $15. Subtotaled those on line 2 and again on line 4. And $1,515 will carry over to Form 1040 and get entered on the wage line. Next on Schedule B, we also have dividend income. The dividend income is showing right here on line 6A of the Schedule K1. We carry that over to the Schedule B, enter it on line 5. The total is $100, and we will then carry that to line 9 of the Form 1040. The next income item we need to deal with is this $1,500 of rent income or net rent income reflected on the Schedule K1. We have a Schedule K1, therefore, we need to complete Schedule E, page 2. On Schedule E, page 2, we indicate the name of the entity that issued the Schedule K1, that's ABC Investment Group, the type of entity that the investment group is, which is partnership, and the employer identification number. Rental income is by default always considered to be passive income, and therefore the rental income is going to be entered in the passive income line, which is going to be column G of line A. There are no offsetting expenses against this passive income. It simply carries over in full to line 30 and 32, and from that point, we carry the number down to line 41 of the Form 1040, Schedule E, page 2, and then we go back up to 1040 and enter that total on line 17 as you see it here. So at this point, we've now entered all of the income: $1,515 of interest, $100 of ordinary dividend income, $6,000 of alimony, $1,500 of rental income, and $30 of jury pay. The total adjusted gross income and total income for Sally Price is $44,145. We carry that down to 37 and carry the total again to line 38 on page 2. Next, we're going to enter the standard deduction for Sally. Her filing status is head of household, and we're told over here that the standard deduction for head of household is $8,500. She enters that amount on line 40. She subtracts line 40 from line 38 and enters $35,645 on line 41. Then on line 42, she enters 2 exemptions, one for herself and one for her niece. Those total $7,400. She does another subtraction to arrive at taxable income on line 43 of $28,245. It is now time to go to the tax tables, look up the tax on that amount of income for a head of household filer. When you do that, you get $3,626. Sally is eligible for a $1,000 child tax credit. That reduces her tax down to $2,626. And the next step is to look at the withholdings on her W-2. And we can see her W-2 shows $5,000 of withholdings. So that $5,000 is entered. We subtract $2,626 from $5,000, and we are left with Sally's refund in the amount of $2,374. So that concludes the review of the Session 4 homework assignment. It is now time to take the Session 4 quiz. Please push pause on video playback. Complete the Session 4 quiz inside the Assignments tab for Session 5. When you are finished with the Session 4 quiz, please resume video playback and we will begin the Session 5 lecture on pension and retirement income. And we're going to begin this session with pensions and annuities and some definitions. And the first definition is contribution, which means to put money into your retirement account. And a distribution means to withdraw, take, or receive money from your retirement account. So we're going to talk about contributions first. Contributions you make to your employer entire retirement account are typically reported in box 12 of your Form W-2. And so I've just popped up a W-2 here for Mr. Buck Rogers. And we've indicated that he has made a contribution to his 401k plan by entering code D in box 12 of his W-2. And one of the things that you would commonly see in a situation like that is that his wages in box 1 are lower than his Medicare wages in box 5. Now, very often they're also lower than the Social Security wages, but in this case, Mr. Rogers' income is high enough that he's maxed out on his Social Security. So his Social Security wages and his actual wages are equal, and it's the Medicare wages that are showing this difference. But you should expect to see a difference in Medicare wages and box 1 wages anytime you have deferrals going on to 401k plans or 403b plans. So that's how we know that a contribution was made to a 401k plan, and you'll notice also that the W-2 has the retirement plan box checked. And that's very relevant when it comes to figuring deductibility of IRA contributions, which is going to be the subject of one of our classes next week in adjustments to income. Form 5498 is another document that is issued to recognize contributions to retirement accounts, but this time it's the individual retirement accounts called IRAs. And contributions to IRAs are reported on this Form 5498. In the world of tax forms, this is actually a relatively new document. I think that the IRS first started requiring that these be issued within the last 5 to 6 years. So I can remember most of the history of preparing tax returns, there was no such thing as this form. The exact date it came out, I'm not sure. It's been out for a while now, but I still think of it as something new. So not too long ago it came out. And this form is issued anytime you make a contribution to an IRA, but also just the fact that you have an IRA. And each year, the management firm or the company managing your IRA account is going to mail this document to you to tell you how much you contributed to your IRA during the year and what the balance or the fair market value of the account was at the end of the year. So if I just zoom in on the screen a little and get a better look at it, we'll see that box 5 says, what's the fair market value of the account? Well, it's referring to what the value of the account was on the last day of the year. This particular form does not show any kind of distributions. It's not intended to show distributions. It only shows contributions and the fair market value of the account at the end of the year, and then also, of course, the type of account it is, whether it's referring to an IRA, a SEP IRA, a simple IRA, or a Roth IRA. So as a tax preparer, when you see these, you're going to be saying, okay, well, does it show that there were any contributions that were made to an IRA during the year, and if so, what kind? If it was a contribution to a Roth IRA, that will have no impact on the tax return at all, unless, of course, it was associated with a rollover from a 401k plan or from a traditional IRA. SEP and simple contributions typically will have an impact on the tax return. It could be that they're already reflected as salary reductions on a W-2, or it could be that you need to enter a deduction somewhere on the tax return as an adjustment to income. But again, this course is not about deductions. This is a course about income from pensions, so I just wanted to point out this document to you because it's showing contributions, and it is necessary to refer to this form when you are completing Form 8606, which we are covering today. Moving on to the next page, we're going to be talking about the 1099-R, and the 1099-R is the document that is used to report distributions from IRAs and other retirement accounts. And of course, whenever you get a 1099-R, you need to be paying attention to whether the distribution is for an IRA or whether it is for other kind of pension plan or annuity. If the distribution is from an IRA, the income will be reported on line 15 of the 1040. And if it's not reporting IRA distributions, in other words, the IRA box is not checked, then the distribution would get reported on line 16. So whenever we're thinking about where on a tax form we're going to enter income from a 1099-R, we have to be looking to that checkbox. If the box is checked for IRA, then we're going to enter the distribution on line 15. If the box is not checked, then the distribution should appear on line 16. Now, when you're using tax software, it's the simplest thing in the world to forget to look for that checkbox and therefore not check or indicate in your computer software that the box is checked. And if you fail to indicate in the computer software that the box was checked or wasn't checked, the software will obviously not do the correct thing with the income. Oh yeah, I did want to point out this part here. You'll see we've got 15A and 15B and 16A and 16B. If the distribution is fully taxable and it is an IRA distribution, then typically line 15A would be left blank and the entire distribution would be shown as income on line 15B. But if this is a partially taxable distribution or a non-taxable distribution, line 15A will have a number on it that differs from the amount entered on line 15B. So 15A typically reveals the total amount that is shown as distributed on the 1099 document, and line 15B is going to show the taxable portion of that distribution. And of course, if we have a distribution from any kind of account other than a IRA, then that distribution would go on line 16. And the gross distribution is typically reported on 16A, and the taxable portion of that is reported on 16B. But if the gross and taxable are equal, the 16A is usually left blank, and 16B is the only number that shows. Now, I do have up in front of you now the 1099-R itself, and the checkbox that I've been referring to is this one right here. If this box has an X in it, then you're dealing with an IRA, and there are more than one kind of IRA. There's the Roth IRA, the Simple IRA, the SEP IRA, and the Traditional IRA. And it doesn't really matter what kind of IRA it is. If it is an IRA, then this box is checked. Okay, so back to this gross distribution box up at the top, talking about 1099-R. Now, some of you might think that walking through the boxes on a document like this is kind of a dull waste of time, and I'm not going to be talking about every single box with you, but learning to read a document like this is a key important part of being a tax preparer. And we have box 1 showing gross distribution. This is the amount that came out of the account during the year. It may or may not be taxable. And the code in box 7 will give you a very good clue as to whether or not that distribution is taxable. So learning what the codes in box 7 means is very important. Now, sometimes there's a number in box 2 and sometimes there's not. If there's a number in box 2, it means usually that the administrator or payer has calculated or tracked the portion of the distribution that's taxable. But you can't always rely on it. Sometimes there'll be a number in box 2A, and then box 2B will be checked, taxable amount not determined. Sometimes box 2A will have a 0 in it or be blank, and box 2B will be checked, saying that the taxable amount has not been determined. Now, as far as the IRS is concerned, if you have not tracked your basis in your account and you have no way of knowing what the taxable portion of the distribution is, then they will assume it is all taxable. It's up to the person who owns the account to track basis over time. And it could be that you have a plan administrator who is tracking that for you that you have been relying on, and it could be you've transferred funds into this account over time, that maybe you started off with an employer account, a 401k, and you rolled over into an IRA, or you rolled one IRA into another IRA. And those types of rollovers make it very difficult to track basis. But the responsibility is always on the taxpayer, and if the taxpayer has not tracked it, then IRS assumes it's all taxable. So from our standpoint as preparers, we have to assume it's taxable until we find something that shows that it's not. And if our client can't provide anything or has no clue what we're talking about, it's likely the case that it's going to be fully taxable. So the taxable amount not determined box being checked does not mean it's not taxable. It means the administrator or payer had no way of knowing how much is taxable, and that's what they're communicating. The other side of the equation, we see total distribution, and when that box is checked, it means that that particular account was closed out. It could have been closed out because it was rolled over. It could have been closed out because it was emptied. The money was just taken out. And again, what happened with that money will be indicated in box 7. The code in box 7 reveals all. So it's very important to pay attention to box 7, what's in it, to identify what you're supposed to be doing. And then we have the box number 5, employee contributions, designated Roth contributions, or insurance premiums. And this is typically going to be used if there is a balance in the account that has a basis where the employee put money into the account and it's been tracked by the administrator of the account. So if things are being tracked correctly, we would have maybe a gross distribution up in box 1 of $10,000, a taxable amount in box 2 of $9,000, and then we'd be looking to see $1,000 in box 5. That's in a perfect balanced world. Of course, we have space in box 4 for federal income tax withheld, and you can control how much federal income tax withholding goes on by giving the plan administrator a document called a W-4P, and I will show you that in just a minute. So here we've got some more instructions box by box, and I will leave you to read those if you care to. I'm going to move down to the box 7 with the distribution codes because this is really important stuff in here, and a lot of these distribution codes you should really just memorize. For example, distribution code 1, distribution code 2, distribution code 3, distribution code 4, And 7 and G and J are codes that you should just know because they're common. They come up all the time. So what is number 1? Early distribution, no known exception to the early withdrawal penalty. If you see a code 1 in box 7, it means the person took money out of the account before their minimum retirement age, which is typically age 59 and a half. And if they did so, unless they meet an exception, which we will talk about in today's class, they're going to owe a penalty. And distribution code number 2 means that it's an early distribution before the minimum retirement age, but a penalty is not going to be assessed or shouldn't be assessed because an exception might apply. And number 3 is disability. The distribution is early before the age of 59 and a half, but no penalty will apply because of a disability. Distribution code number 4 is actually one I see quite often. That means that the person who is bringing you the document is holding a document showing a distribution from a plan that they've inherited. Someone died, left them their pension plan, and now they're taking money from it. It's a death benefit, and that death distribution is not subject to a penalty, even though the person holding the document who received that money could be quite young, definitely under age 59 and a half. Now, distribution code number 7 is the one that's supposed to be the most common because, after all, when people retire, they are receiving normal distributions and there's no penalty. Now, the thing is, though, that Americans are not terribly good at disciplining themselves, and although they're not supposed to touch their money before they're age 59 and a half, we observe as tax preparers that they do it all the time. And so much as I'd like to say 7 is the most common code that I see, and it probably is the most common code I'd see, number 1 is a tight second. It would be really hard for me to say for sure that 7 is more common than 1, but that's probably just an impression and not fact. All right, then we move on down. And the next code I wanted you to take a look at was code number G. This has to do with a direct rollover and rollover contribution, and this is another quite common code. When you see a code G, it means none of the distribution is taxable or should be taxable because it was directly rolled over from one qualified plan to another. However, there is an exception to this rule in that if the money came from a traditional plan of some kind, a tax-deferred, salary-deferred plan, or a traditional IRA, and it was rolled into a Roth IRA, then you're going to have a taxable transaction. So just rollovers into Roth IRAs definitely have tax consequences, but rollovers from traditional pension plans to traditional IRAs typically have no tax consequence. And then we have code H, direct rollover of a designated Roth account to another Roth IRA. Code J, early distribution from a Roth IRA with no known exception to the early withdrawal penalty. And code number L is one that I see relatively often as well. This has to do with unpaid loans that are treated as distributions. And this will happen if you borrowed money against a pension plan. You're supposed to be repaying it, and then you don't. Sometimes you have been repaying it, but then you terminate employment with a particular employer that that plan is with, and at the time that happens, the loan is treated as a distribution. And then, of course, there's some other codes that I'm not going to read to you. Oh, here's an important one, code number S. Code number S is important because if you see a code S in box 7, your customer is in big trouble. I say they're in big trouble because they've taken an early distribution from a simple IRA in the first 2 years. There is no known exception for them on that action, and their penalty is going to be 25%. So the normal early distribution penalty is 10%, but if you see a code S, that's going to trigger a 25% penalty. I've seen 1 or 2 of those in 20 years. They're not too common, but they do come up. Next in the line, we're going to talk about a W-4P, withholding certificate for pension or annuity payments. And most distributions are partially or fully taxable, but in certain cases, mandatory withholding rules will require a plan administrator to back up at a rate of 20%. That typically happens when people empty out their IRAs and they're not doing any rollovers. The plan administrator under federal law is required to do a 20% backup withholding. And that rule has been around for probably about 18 years now. I have been in it long enough where I remember that they didn't have to do withholding, and then they started to have to do withholding. So the thing with 20% is it can be enough, it may not be enough. If a person's subject to a 10% early withdrawal penalty and they're in the 15% bracket, that's a total tax of 25%, and holding out 20% would therefore not be enough. So it's a minimum rate of withholding, but not always enough. if you have a normal distribution going on at the time you retire, you should be completing Form W-4P to tell your plan administrator how much to withhold. And it looks a lot like the Form W-4 you use when you are an employee. It has worksheets to help you determine how much you should have withheld. And again, how much you really should have withheld would depend on your filing status, the number of deductions you have, and other sources of income that you have. But you can use this form to adjust withholdings. Yes? There's a question in the classroom, if you're receiving regular distributions from your pension plan and at the end of the year you haven't had enough tax withheld, is there a penalty associated with that? Well, as a matter of fact, there's penalties associated with underpayment of tax regardless of the source of income, and whether your income comes from Social Security, pensions, a job, investments. The IRS doesn't really care where your money comes from. If at the end of the year you've not paid in enough, they're going to assess a penalty. And we actually will be talking about that in, I think, our class next week. We will be talking about IRS penalties, how they're calculated, estimated tax rules, and so forth. So it really is the taxpayer's responsibility to do enough withholding, and if they're not doing enough withholding, the simple rule is if you file and you owe more than $1,000, unless some other calculations are working to your favor, you're probably going to owe a penalty, and the penalty is going to be 5% of the difference between $1,000 and what you owe. So if you owe $5,000, you're going to have a penalty of 5% on the distance, the separation between $1,000 and $5,000, and that would be a couple $100, right? All right, determining the taxable portion of your distribution. Your distribution from your retirement plan may be partially or fully taxable. To be partially taxable, you must have made after-tax contributions to the plan or annuity. Your after-tax contributions are your cost in the plan. Your distribution from your retirement plan will be fully taxable if either of the following is true. Number one, you made only pre-tax contributions. Or number two, your employer paid all of the costs of the contributions for you. Cost or investment in the contract. Before you can figure out how much, if any, of your pension or annuity distribution is taxable, you must first determine your cost in the plan. Your total cost includes amounts you paid and amounts your employer paid that were taxable at the time you paid them. But if all of your costs in the plan were pre-tax contributions or they were made on your behalf by your employer, you do not have a cost in your plan, which means all of your distributions are fully taxable. And the reality is that for virtually everyone out there, they're going to be making pre-tax contributions to the 401k. That's one of the whole points of it. You can do salary reduction, put the money in there. You don't pay tax on it at the time. If you work for a good employer who has the resources available, they may also be making contributions for you on your behalf, matching contributions, and that money is building tax-free. So that's the whole point of them. And so for most people, it's really quite simple. If they had an employer plan, odds are there's no cost in it. But sometimes there is a cost, and when there is a cost, there has to have been tracking done over time to figure out what that is. Now, the kind of plan where it is entirely possible and common to have a cost is an IRA, because it's possible to make taxable or tax-deductible contributions to an IRA, but it's also possible to make non-deductible contributions to an IRA. And in our classes next week in Adjustments to Income, we will talk about the rules that impact whether or not a person is allowed to make a tax-free contribution to an IRA, or whether they are only allowed to make an after-tax contribution to the IRA. And if they are allowed to make only an after-tax contribution to an IRA, they're supposed to file Form 8606 at that time to tell the IRS how much after-tax contribution they've made. In other words, how much they've added to their basis. So Form 8606 is kind of a two-sided form. It serves two functions. The first function is to show or tell the IRS, hey, I just put money into my IRA and I couldn't deduct it on my tax return, therefore I've created a basis in my account. The other purpose of Form 8606 is to say to the IRS, hey, I've just taken money out of my IRA and it's an IRA that I had a basis in, so I want to recover a portion of my basis, and therefore the full distribution I've just taken from my pension plan or my IRA plan is not fully taxable. And I'm going to use Form 8606 to calculate the portion of my distribution that is taxable. Okay, so let's take a bit of a look at Form 8606. This is one of the forms that I asked you to print that we're going to be working on in today's class, and I'm going to have it up on the screen in front of you in a minute, so if you didn't print it, it's not a panic. but we're going to spend quite a bit of time this morning talking about this form. I find that, at least with the staff that I supervise over time, this form is, people don't get it. So I think we need to spend some time on it, because if my staff doesn't get it, then I'm figuring the average preparer out there doesn't get it. So if you withdrew money from a traditional IRA in which you have a basis, and we're going to be talking about how to use the form today in terms of when you take money out and you have a basis. In our next class, we will talk about what to do when you put money into an IRA and how to deduct it or figure your non-deductible contribution. But today we're only talking about how to use this form when you take money out in which you have a basis. So again, the form is used to report the amount of the distribution and to calculate the taxable portion of the distribution. If you do not have a cost basis in your IRA because all of your contributions to the IRA were fully deductible in all of the prior years where you made contributions, then your entire distribution from the traditional IRA is taxable and you don't need to complete Form 8606. So this form is used only to make non-deductible contributions or to report partially taxable distributions from an IRA. Either way, it's tracking basis in and tracking basis out. Yes?
Session 5, password number 2 is pinto, P-I-N-T-O.
And it's kind of a scary form. Some forms are more intimidating than others. I think this is a rather intimidating form, especially because it's 2 pages long. And when you start to get more than 20 lines, it starts to be a lot. But let's take a look at Part 1 up here. Part 1 is used to report non-deductible contributions to traditional IRAs and distributions from traditional SEP and simple IRAs. Part 2 is used to report 2011 conversions from traditional SEP or simple IRAs to Roth IRAs. Now, of course, in 2010, the IRS allowed people to take money from a pension plan or a traditional IRA and roll it over into a Roth IRA, but not have to report the income from that rollover until 2011 and 12, and essentially split the income between those 2 years. But that was 2010. In 2011, you can still do the same kind of rollover, but it's going to be all reportable in 2011. So this box has to do, or this section, Part 2, has to do with conversions in 2011 from traditional SEP or simple IRAs to a Roth IRA. Moving on to page 2 of the form, we have distributions from Roth IRAs that are reported in Part 3. We complete this part, however, only if you took a distribution from a Roth IRA in 2011. For this purpose, a distribution does not include a rollover, a qualified charitable distribution, a one-time distribution to fund an HSA, recharacterization, or a return of certain contributions. So Part 3, you can see lots of line numbers there. If you were having to work and fill that out by hand, your brain would be rattled. We get so dependent on tax software that we really don't realize what the software is doing. It's applying tax law and reasoning its way through all of the different rules that affect these types of transactions. And part of what happens when we're a tax preparer is if we don't fully understand the law, we punch some numbers into our computer puts some numbers on a form, and then we cross our fingers and hope it's right. But as we will have learned in the ethics class that I taught last week, that the IRS does not actually like it when you do that, because that's considered to be incompetence or negligence, one or the other, right? Neither of them is a compliment to us as a tax preparer. So to be in compliance with federal ethics rules, we are supposed to be competent and diligent and not negligent. So our job as preparers is to understand what's going on in those boxes. Moving on down to Part 4, certain distributions from designated Roth accounts. We complete this part only if you took a distribution from your designated Roth IRA in 2011, and in 2010 you had an in-plan rollover to your designated Roth account, and you completed lines 25A and 25B on your 2010 Form 8606 that you filed to report that in-plan rollover. So each of those sections has a purpose. And I'm not going to spend all day on this form. It would be easy to do that. But we are going to look at a couple of illustrations of how the form works. So let's talk now about when the form is required. Kind of reading the form tells you a little bit about when it's probably required, but there are some specific rules. And if you go to read the instructions for Form 8606, the first thing you read in rules typically is, do I need the form? When is it required? And it's important to know when it's required because as a tax preparer, you're supposed to know, hey, do I need to fill out this form? Did my software generate it automatically just because I did a little bit of data entry? Or do I think the form should have generated, but I don't see it? And if I don't see it, how do I go make it happen? And what am I expecting the outcome of having completed that form to be? So, situations where the form is required. You made a non-deductible contribution to a traditional IRA for 2011. Or you received distributions from a traditional SEP or simple IRA in 2011, and your basis in traditional IRAs is more than, well, 0. You contributed an amount from a traditional SEP or simple IRA to a Roth IRA in 2011. That is, you converted an amount from a traditional SEP or simple to a Roth during the year. Or you rolled over an amount from a qualified retirement plan other than a designated Roth account to a Roth IRA in 2011. Or you received distributions from a Roth IRA in 2011. Or you rolled over an amount from your 401k or 403b plan to a designated Roth account within the same plan, also referred to as an in-plan Roth rollover. Or you received a distribution from your designated Roth account that is allocable to an in-plan Roth rollover. Or you made a repayment of a qualified disaster recovery assistance or qualified recovery assistance distribution that is attributable to previously non-deductible contributions. Or you received a distribution from an inherited Roth IRA that was not a qualified distribution, or from an inherited traditional IRA that has a basis, or you rolled over an inherited plan account to a Roth IRA. So with all of that explanation, I'm sure you've learned absolutely nothing by reading those rules. Maybe filling out a form together will help. So I always find seeing it how it's done is the best way to learn, so I try to put lots of illustrations in my classes. And here's our first illustration. George Judson, born in 1950, is retired. Well, how old is George in 2011? I think that would make him 61, right? Anyway, he's over age 59 and a half. That's what we care about. So we're not looking for any penalties for Mr. George Judson. During the year, his income included $15,000 of Social Security benefits and distributions from his pension plan and his traditional IRA. George's basis in his traditional IRA for 2010 and earlier years was $40,000, and his IRA had a value of $200,000 at the end of 2011. Copies of his 1099-R are attached. Well, how would we know what his basis in his traditional IRA was? Well, I've told you in the problem, because if you didn't have a basis, there'd be no point in filling out Form 8606. It would all be taxable. But I'm telling you as a basis, and Mr. George Judson was a very clever man because during his lifetime, as he was contributing to his IRA, he knew enough to track his basis. And every year, he filed Form 8606 to keep track of that basis. He either did it because he's very smart or he had a smart tax preparer, one or the other. And at the end of the year, his account had a value of $200,000. Well, that should be reported on that document we showed you way up at the start of the class today, right? That 5498 form, this one? This form should have an amount in it, in box 5. And I'm telling you he has this form, and it has $200,000 in that box. That's how we know that number. So going back down to Mr. Judson, we're going to take a look now at his 1099-R. The 1099-R shows a gross distribution of $12,000. It says taxable amount not determined. We can see that the IRA SEP simple box is checked and that it's a normal distribution. So he's not going to be subject to a penalty. The administrator of the plan does not know what his cost basis is, but I've told you what it is, $40,000. He also has received another 1099-R, and this one is for just a regular type of pension plan. You can see that the IRA box is not checked. It's a normal distribution, and it's a fully taxable distribution. So right off the bat, we know we're going to have to do an 8606 worksheet. Actually, not the 8606 worksheet, but the Form 8606 itself. And we're going to have to fill out 1040, and we're going to have an entry on line 15 for the IRA, and we're going to have an entry on line 16 of Form 1040 for the pension. Already my little tax preparer brain has gone in that direction. So here's how we're going to complete George's 8606. We start on line 2 by entering his basis. Now line 1 is used when you're making a contribution to your IRA. And he did not make any contributions during the year. The only thing he did is take money out. So line 1 is blank. Line 2 is where we show the total distributions that he took for the year, or pardon me, your total basis in the plan, rather. So line 2 is his basis in the plan, $40,000. And there's no other calculations going on anywhere in here. The 40,000 carries down to line 5. Then on line 6, we enter his total fair market value of the account on the last day of the year. That is 2011, and it was 200,000. Then on line 7, we show the distributions. This is the amount shown on the 1099-R, and that was $12,000. The next thing the IRS does is it says, okay, the end of the year it was worth 200, and during the year you took out 12. That means technically at some point it must have been worth $212,000. Now, there probably was growth in the plan, so it wouldn't be an exact formula like that. You couldn't take the high point of the year, subtract out all of the distributions, and get to the year-end amount, because the fund will change value over time. But at any rate, this is how their formula works. Take the end of the year, add the distributions for the year, and put that amount, that total, on line 9. The next thing is to take our distributions, the distributions for the year, line 7, and divide that by line 9. And when we do that, we get this total right here, 0.1887. That represents the percentage of the plan in which he has a basis. His cost basis is essentially about 18% of the value of the plan. And then we're going to multiply that ratio that we came up with by the distribution for the year. And when we do that, we get $2,264. The $2,264 is going to be a return of cost to George. This is the non-taxable portion of the distribution. The next step is to subtract the $2,264 return of cost from the gross distribution, and the number we get is the taxable part, $9,736. $9,736 is going to carry where? Line 15B of Form 1040. And what are we going to put on line 15A? $12,000. So let's take a look at the front page of his 1040. And there you'll see we have $12,000 on line 15A, and the taxable portion that we used Form 8606 to figure is entered on line 15B. And the pension itself, we can see line 16A is blank. It could be your software puts a number there every time. Our software tends to sometimes put it there, but only when there is a difference between 16A and 16B. And if they're the same, our software just puts the amount on 16B. That's the total distribution, and it's also the taxable distribution from his retirement account. And then I told you he received some Social Security benefits during the year, $15,000, and my software calculated the taxable amount for him. And later in today's class, towards the end of the class, we're actually going to get into Social Security benefits worksheets and figure out how we determine this number here. Of course, our software does that, right? But how does it do that? It's just like magic. So we're going to learn the formula to determine the taxability of Social Security benefits. The next topic of the day is rollovers. If you withdrew cash or other assets from your qualified pension or IRA, you can defer tax on the distribution by rolling the funds over into another qualified plan or IRA. You have 60 days to roll the taxable portion of your distribution into another qualified plan or IRA. You can choose the direct rollover option by having the administrator of the old plan transfer the distribution directly to the new plan or IRA. And if you choose to withdraw your taxable portion without rolling it over to a new plan, the plan administrator must generally withhold 20% income tax from that distribution.
Session 5, password number 3 is piebald, P-I-E-B-A-L-D.
Okay, loans from pension plans, distribution code L. Earlier I mentioned that it's possible to take out a loan against your pension plan. And occasionally I have clients who do that. It's a pretty good deal. You need a down payment on your house, but you don't have enough cash in the bank. So you can go to your pension plan administrator and borrow money against the pension plan and use it to make a down payment on a home. There are limits on how much you can borrow from pension plans. There's rules about what you're allowed to borrow and how you repay it. I'm not familiar with any of those rules at all because they're not my concern as a tax preparer. My concern as a tax preparer is what happens when they don't repay that loan, and then they get a 1099-R with a code L on it. Well, a code L, it means that it was a loan that went bad, and it's treated as a distribution, and if they're under age 59 and a half, they'll be subject to that 10% penalty. So you may be able to borrow money from your qualified plan, annuity plan, tax-sheltered annuity program, government plan, or other contract purchased under any of these plans for purchase of a first home. I believe there's other reasons why you can borrow from it as well, but purchase of a first home is the one I'm the most familiar with. If you close out of the plan prior to paying off that loan, or if you default on paying back the loan, it's going to be treated as a distribution, and you will see that code L in the 1099. Additional taxes. Pension plans and IRAs are given special tax treatment to encourage people to save for their retirement. Penalties exist in the form of additional taxes if the funds within a plan are withdrawn early, these are called early distributions, or the minimum required amount is not distributed. That means you did not receive the minimum distribution. So we're going to talk about the tax on early distributions first. The tax on early distributions is commonly referred to as the early withdrawal penalty. But if you read the instructions, the IRS typically refers to it as the additional 10% tax. And so I call it an early withdrawal penalty. Lots of tax professionals call it the early withdrawal penalty. But then if you're a tax student and you're reading the instructions, you never find the word early withdrawal penalty anywhere because IRS refers to it as the additional 10% tax on an early withdrawal. And you will generally be required to pay the additional 10% tax on your early withdrawal from your qualified plan, IRA, or annuity if you withdraw funds before you reach age 59 and a half. The tax applies to the taxable part of the distribution only. So this is important information. If you contribute money to a Roth other than as a rollover to the Roth, you just make a direct contribution to that Roth, you have a basis in the Roth. So let's just suppose I go open my Roth IRA and I put $5,000 in it. And the next year I put another $5,000 in it, but the stock market's not doing so hot, and so my Roth IRA is worth $8,000 after 2 years. So I decide to empty it out and get my money out. The thinking might be easily, oh, I've got income. But the answer is you only have income on a Roth IRA if it went up, because you have a basis in everything you put in there. So if I open up a Roth and I put 10 into it, and then I empty it out and I take out 8, and that's all that's left in there, the reality is I actually have a loss. I don't have income. So by all means, don't be assuming that when a person takes money from a Roth, they ever have income. So when we're concerned about whether or not we're going to assess income tax and whether or not we're going to assess a penalty, at least on a distribution from a Roth, we first have to figure whether or not they had a basis. And how are we going to know what their basis is? Well, we're going to have to ask our client what our basis is, and that means they're going to have to go back and look at a record of all the contributions they made over time and where those contributions came from. If those contributions came from a rollover in 2010, well, we don't have a basis per se until all of that income from the rollover has been reported in income in either 10, 11, or 12. But outside of 2010, that weird year, most of the time when you do a conversion to a Roth, it's reportable in the year of the conversion. So if in 2010, or pardon me, if in 2011, I do a rollover from my 401k plan at work to my Roth IRA, that means in 2011 I'm going to report that income, and it's not going to be subject to a penalty. Then in 2012, I need the money from my Roth and I take the money out. Do I have income from that? I've already reported the income in 11. So those are some of the things that we have to be concerned of when we're looking at Roths. Now, of course, most of the time when people get a 1099-R and it's an early distribution, it's going to be an early distribution from a traditional IRA or most commonly a 401k plan at work. And in those kinds of situations, the distribution is fully taxable in most cases, and it's also going to be subject to the penalty. So that's what we're going to be talking about here, is that typical situation where you're taking money out, you have no basis, therefore the entire distribution is taxable, you're too young, now you have to pay a penalty. So how do we figure out what that penalty is and enter it on the return? And then secondly, is there any way that I can get out of the penalty so that I don't have to pay it? So for most people, a distribution code of 1 means there will be a 10% penalty owed on the taxable portion of the distribution. But if it was a distribution from a simple plan, then the penalty is going to be 25%. And if you see that code S, you're going to be dealing with a 25% penalty. And I think I've seen 1 or 2 25% penalties in all my years. They're pretty rare. And then also there is a separate 5% additional tax on certain early distributions from deferred annuity contracts. So how to report an early distribution from an IRA, pension, or annuity? You begin by reporting it as you usually do on either line 15A or 16A, and then carrying over the taxable amount to lines 15B and 16B, as you normally would on the 1040. That's the first step of reporting the distribution. The second step of reporting the distribution is to determine how much of a penalty there is, if any, and enter that penalty on line 58 on page 2 of your Form 1040. Now, if there is no exception to the penalty, that the entire distribution is subjected to a penalty, you simply calculate the penalty and enter it on line 58. But if there is an exception to the penalty, in other words, that your client might not owe that penalty, then you need to fill out a form, 5329. So 5329 is the form that we're going to talk about next. We're going to learn all the rules of when the form is required. This is a form where I do my clients a lot of help. I do my clients a lot of help by knowing the times and places that they're going to qualify for an exception to this penalty. Because people take money out of pension plans early all the time. And if I have every possible exception to the penalty that they could qualify for in my little tax preparer brain, then when I see that I think that they're subject to the penalty, I'm going to start rattling off all the possible reasons why they might not have to pay it, until maybe, if I'm lucky, I'm going to hit one. I'm going to say, did you pay for health insurance while you were unemployed? Have you ever asked that client that question? Because I've had clients say yes, and if they did, and the money came from a traditional IRA, they don't have to pay the penalty to the extent that they paid for health insurance while they were unemployed. So those are the types of things we do. And of course, one of the more common ones is higher education and first-time home purchase, but there's rules about those as well. So exceptions to the early with distributions tax for IRAs and pensions. I'm going to go through and list some exceptions right here to this point. Everything between here and here, it does not matter what kind of a plan you took the money from. You can qualify for an exception to that early distribution tax if you have one of these reasons that applies to you. But down here we have additional exceptions that apply to IRAs only. So if you took it out of anything other than an IRA, the exception won't apply. So the first exception is the payments are made as part of a series of substantially equal periodic payments that made at least once per year for your life or life expectancy, or the joint lives or life expectancies of you and your beneficiary. If the qualified plan is not an IRA, you must have separated from servicing your employer. So essentially it's saying you retired early and you started to take money from your plan early as equal payments over time. You are under age 59 and a half, but you've retired and you've basically started up distributions the same way a retired person would, even though you're not, say, 59 and a half age. Or the payments were made because you became totally and permanently disabled. Now, at the time you start taking those distributions, you should really tell the plan administrator, hey, I'm disabled, so that they can put a code 3 in the box. But maybe you didn't realize you were supposed to tell them you became disabled, or that you're taking the distributions because you are disabled, and so they just put a distribution code 1 in the box. And then at that point, you're going to need to fill out Form 5329 and claim that you are totally and permanently disabled as an exception. Payments were made to a beneficiary on or after death of the plan participant. Well, again, that should be not subject to the penalty with a code 4 in there as a death benefit. But maybe there's some reason why they don't have a code 4 in there. They have a code 1, so you're going to claim that exception. The payments were made from a qualified retirement plan other than an IRA after your separation from service in or after the year you reach age 55. So again, this is basically saying I retired early and I was at least age 55, but if I'm a public safety employee like a fireman or a police officer, then I can only have to be 50 years old. Payments made from a qualified retirement plan other than an IRA to an alternate payee under a qualified domestic relations order. That's divorce. You're getting divorced and the spouse gets half of it or even all of it. And in a situation like that, you've been ordered to take all of the money out, part of the divorce settlement, and turn all of the cash over to the spouse. That's an exception. And although I can't say I run across this terribly often, this is one that's come up in my life as a preparer more than once. Payments made from a qualified retirement plan to the extent that you have medical expenses in excess of 7.5% of your adjusted gross income. That's a pretty big number. And of course, very few people ever spend more than 7.5% of their income in a year on medical, unless something pretty significant happens. When do I see more than 7.5% getting spent on medical? People have major surgery during the year. Income is fairly low, and they don't have health insurance, so they're paying out of pocket for all of their medical expenses. More commonly, when I'm getting into people who are elderly, and especially when they get to a point when they're entering a nursing home, that's when I'm going to see medical expenses shoot up high enough that regularly they're going to have enough to itemize. So if you had some big medical bills during the year and they are significant enough that you're able to itemize them and put them on Schedule A, and you can show that they're more than 7.5% of your income, to the extent that the medical is more than 7.5% of your income, you're going to be able to claim an exception to the penalty. So this penalty is not an exception based on the amount you spent on medical. It's an exception based on the amount by which medical exceeded 7.5% of your income. If you reach an age where you are retired but you're too young from Medicare, so you're self-insuring, that can put you in a situation where your medical insurance by itself can put you over 7.5%. And yes, I do sometimes see that, although so few people can independently afford health insurance anymore. Most people who don't have health insurance at work don't have it at all, is my experience. Payments made from an employee stock ownership plan for dividends on employer securities held by the plan is another exception. Payments made from a qualified retirement plan due to an IRS levy of the plan. That would be you owe a bunch of back taxes to the IRS and they essentially force you to cash out your plan to pay them. They won't make you pay the penalty on that distribution. Isn't that nice of them? And then qualified distributions to reservists while serving on active duty for at least 180 days. That's another exception. So all of these exceptions up here apply to IRAs and pension plans both, with the exception of this one right here, which does not apply to IRAs. That is, you reached age 55 and retired. That's only for separation from servicing an employer and not an IRA. But everything else in here is for IRAs and pension plans. But next we're going to come up on ones that apply only to IRAs. And the unfortunate thing about these particular exceptions is that they are the most common exceptions. And so the exception that leaps to mind that we're hopeful will help, the IRA box is not checked on that 1099-R. Darn it. So in order to qualify to claim these exceptions, the distribution has to be shown on a 1099-R where the IRA box is checked. And if the IRA box is not checked, you can't use these exceptions. Firstly, to the extent of medical insurance premiums that you paid while you were unemployed. So unlike this one here where the medical expenses have to exceed 7.5% of your income, down here we merely have to show that you paid medical insurance while you were unemployed. And this is one that's actually come up quite a bit because of our bad economy. People have gotten laid off and they've been paying COBRA while they've been laid off. And so I've had this one come up. And of course, because you're laid off and unemployed, you're cashing out your IRA to live on, right? So in order to take advantage of this exception, a person would have to do a rollover from their traditional a rollover from their pension plan into their traditional IRA and then take the money out of their traditional IRA, and then they could qualify for this exception. The next one is to the extent of your higher education expenses that you paid through cash or loans for yourself, spouse, your children, or your grandchildren. So if you paid for higher education expenses for yourself, your children, or your grandchildren, you can claim an exception to the early distribution penalty to this extent right here, but only if it came from an IRA. And then up to $10,000 may be withdrawn penalty-free for a first-time home purchase for yourself, your spouse, your children, your grandchildren, or your ancestors, provided the home purchase occurs within 120 days of the distribution. I see a question here from Jason Cooper who says, what is the treatment when Roth or traditional IRA funds are contributed and then distributed in the same tax year? Well, if you put money into a traditional IRA or a Roth IRA and then take it out in the same year, the tax consequence is as if there was any growth in the plan during the time it was in there. So let's suppose I open up a traditional IRA in 2011 and I put $5,000 in, and the $5,000 is for 11. I'm not deducting it on my 2010 return. So I put it in for 11, and then a few months later I go, oops, I need that money, and I take it out again. Well, the question is, did it grow? Did the 5,000 turn into 5,500, say, during the time it was in there? If it turned into 5,500 during the time it was in there, it experienced growth. And so that growth would be taxable. But if it went down in value or there was no change in value, then there would be no income from it. but the likelihood is that there would still be a 1099-R issued, and so you're going to have to deal with it on the tax return, most likely with Form 8606. So how do you claim an exception to the early distribution tax? So we've been talking about that there is a penalty, and we've talked about reasons why you might not have to pay the penalty. How are you going to be able to claim an exception to that early distribution tax? Well, you do so by completing Form 5329. 5329 is a 2-page multi-part form, but when we're talking about claiming an exception to the penalty for early distributions from IRAs and other retirement accounts, we're dealing really with only the first 3 or 4 lines. And those are all in Part 1 of the form. In Part 1 of the form, you enter the amount of the early distribution on line 1. Then on line 2, you enter the early distribution code that qualifies you for the exception to the additional tax, and you also enter the amount of money that is not going to be subject to the penalty. And here are the exception codes that you need to enter. And these exception codes do not necessarily line up with the order of the 1099-R form. So for example, on Form 1099-R, there's all these codes that apply to Box 7. Some of those codes are a match to the early distribution codes you see here, but most are not. The 2 that are a match are 3. So if you have a 1099-R that has a code 3 in Box 7, that means there's a disability. And if you enter a code 3 on 5329, that also means disability. And on Form 1099-R, code 4 means death benefit. And on Form 5329, code 4 means distributions due to death. But other than that, there's no similarity. So don't be thinking that there should be. Okay, so code 1 has to do for people who separated from service after the age of 55. Code 2, distributions made as part of a series of substantially equal periodic payments made at least annually for your life. Code 3 is disability. Code 4 is death. Code 7 is IRA distributions made to unemployed individuals for health insurance premiums. Code 8, IRA distributions made for higher education purposes. And Code 9, IRA distributions made for purchase of a first home of up to $10,000. There is a limit on that. So if they take $30,000 out of their IRA to buy a first home, they're going to be able to not pay penalty on the first $10,000, but the remaining $20,000 that they took out would still be subject to the penalty. Moving on to the next page, we have 5329 in front of you here. So line 1 is where we enter the amount of early distribution. In the space available on line 2, we enter the code that qualifies us for an exception to the penalty. And on line 2, we enter the amount of distribution that is not subject to the penalty. Then on line 3, we enter the difference between line 1 and line 2, and the amount on line 3 is the amount that we do owe a penalty on. We're going to calculate that penalty and then enter the penalty on line 4, which is typically 10% of the amount on line 3, but in the case of a simple plan, it would be 25%. And I'm just going to have you work briefly on doing a quick fill out of Form 5329. It shouldn't take you more than about 3 minutes to fill it out, where we have classwork assignment number 1. It says Jane purchased her first home. She withdrew money from her IRA to make a $20,000 down payment on her home 100 days before she purchased it. Her 1099-R is attached. Prepare her Form 5329. The first point is to figure out whether or not she's going to qualify for relief from the penalty, and the second part is how much relief can she claim. On line 1 of the form, we're going to enter her early distribution, which was $20,000. Then on line 2, we're going to enter the code that she qualifies for, and code number 9 is the one that qualifies for first-time home buyer. And of course, when you look at the 1099 document itself, let me just flip back to it real quick. Right here, we were looking for this IRA box to be checked. The IRA box is checked, so that means she can claim the first-time home buyer exception. If this box were not checked, then she would not be allowed to claim this particular exception. So going back up onto the answer key, the exception code, as I said, is number 9, but when you have a first-time homebuyer exception, it's limited to $10,000. So we're going to subtract 10 from 20, and that leaves 10 on which the penalty is due, and of course that will give her a $1,000 penalty. So here is her 5329, and we're just filling out the very top portion of it. 20,000 of distribution, 10,000 is an exception, 10,000 is subject to the penalty. The penalty is $1,000, and that's it. That's as easy an assignment as you will ever get from me in your life. Part 2 of this form is used for reporting additional tax on certain distributions from education accounts. And I've actually never had a client who's taken an a non-qualified distribution from an education account. I have almost no clients who even set them up. So I just don't find the Coverdell ESAs to be a particularly good deal. There is another kind of education savings plan called a 529 plan that are set up at the state level, state college savings plans, and they do not limit the amount you can contribute to them. And so I have lots of clients who use those, but these Coverdell ESAs are incredibly rare. Anyway, if you happen to have a client who did open one up and put money in, and then they take a distribution, whether or not the distribution is tax-free depends in part on whether the distributions are equal to or less than the amount of the adjusted qualified education expenses that the beneficiary has in that same year. So the whole point of an education plan is you open it, you put money in there, and it sits there. And you're never allowed a deduction for what you put into an education IRA. So it's a little bit like a Roth in that you can put it in and it's allowed to grow tax-free while it's there, but you're always going to have a basis in it, always. And then the question is, once you start taking money out, is the money that you take out taxable? And the answer is, well, if it's spent on higher education, qualifying higher education, then it wouldn't be. But if it's spent on anything else, then it could be. And how much is going to be taxable? Well, it's going to depend on your basis, right? You have to figure out how much your basis is, subtract out the basis, determine the taxable amount, and then to the extent the taxable amount was not spent on qualifying expenses, and obviously it's taxable because it wasn't, then you could have a penalty. And that would be figured in Part 2 of Form 5329. On this form, you'll see here distributions included on line 5 that are not subject to the additional tax. See instructions. Line 6 says the additional tax does not apply to distributions that are includable as income if the distribution is made to the death or disability of the beneficiary or made on account of a tax-free scholarship, allowance, or payment described in Section 25A, or made because of attendance by the beneficiary at a U.S. military academy to the extent the distribution does not exceed the cost of advanced education as defined in Title 10, or included in income because you use the qualified education expenses to figure the American Opportunity and Lifetime Learning Credits. Well, one of the rules about the American Opportunity and Lifetime Learning Credits is that you can't claim those credits if you're excluding income under the college savings or under these college savings plans. So clearly the opposite side of that is to report income from the distribution from your Coverdell ESA and include it in income. But it's not going to be subject to a penalty because it actually was spent on education. But you're voluntarily putting it into income so that you can claim the education credit, which of course those education credits are usually a pretty good deal if you qualify for them. Now parts 3 through 7 of Form 5329 are used to report the additional tax on excess contributions to traditional IRAs, Roth IRAs, Coverdell ESAs, Archer MSAs, and health savings accounts, or HSAs. In all of these cases, a 6% penalty is imposed on taxpayers who contribute more to a traditional IRA or Roth IRA than is allowed by statute. A 6% penalty also applies to excess contributions to Coverdell ESAs, Archer MSAs, and health savings accounts. 6% penalty applies each year to the excess amount as long as it remains in the IRA. So if you take it out, then you don't pay it. But if you leave it in there, you continue to pay the penalty. And you use Form 5329 and the appropriate part to figure the amount that you owe. And I'm not going to show you those, but that's what the form is for. Now, how do you correct an excess contribution? You can avoid the excess contribution penalty if you withdraw the excess by the due date for filing your return, including extensions. The withdrawal is treated as a tax-free withdrawal if you do not take a deduction for the contribution and you withdraw any interest or other income earned on the contribution while it was a part of the IRA. Part 8, additional tax on excess accumulation in qualified retirement accounts, including IRAs. You must begin to receive payments from your qualified retirement plan not later than your required beginning date, and the government has established these dates to help ensure that the payments are made to you and your beneficiaries. The additional tax for failing to take out enough money when you are supposed to is 50% of the amount that you should have taken out and didn't. The excess accumulation is the difference between the amount that was required and the amount that was actually distributed, and it's a 50% penalty. That's a common test question. I think whether you're taking the RTRP test, the enrolled agent test, or one of Oregon's prepare exams, that's a question you're going to get asked. What is that penalty? The required minimum distribution penalty is 50%. Required minimum distributions, a little bit more about those. You cannot keep retirement funds in your account indefinitely. You generally have to start taking withdrawals from your IRA or retirement plan account when you reach age 70 and a half. Roth IRAs do not require withdrawals until after the death of the owner. The minimum amount you must withdraw from your account each year is your required minimum distribution, or RMD. Here are the rules for IRAs. The annual minimum distributions from traditional IRAs, simple IRAs, and SEPs must begin by the year you reach age 70 and a half. You can choose to delay receipt of the first distribution until April 1st of the year following the year you turn 70 and a half. Therefore, the required minimum distribution for each year must be made by December 31, or thereafter, the required minimum distribution must be made by December 31. So if the first distribution is delayed until April 1st of the following year, then the second distribution must be made by December 31 of that same year. So here's the year you reach age 70 and a half. Let's suppose I turned age 70 and a half in 2010. I can delay making my first distribution until April 1st of 2011. And if I do that, then I have to take my remaining distribution or my next qualified distribution by December 31 of 2011. That's what that's saying. And IRS has a couple of examples that I pulled from their website and stuck in here. You are retired and your 70th birthday was June 30th, 2011. You reach age 70 and a half on December 30, 2011. You must take your first RMD for 2011 by April 1, 2012. Example number 2. You retired and your 70th birthday was July 1, 2011. You reach age 70 and a half on January 1, 2012. You do not have a required minimum distribution for 2011, and you must take your first required minimum distribution for 2012 by April 1st of 2013. And then, of course, you would have to take another distribution by December 31st of 2013. The next thing we're going to look at today is annuity income. Now, the place that we typically see these statements, and they look a lot like this, is for federal government retirees, people who've worked for the post office, people who've worked for the IRS, people who work for the federal government. They get these annuity statements. And how federal retirement plans work is quite a bit different than how retirement plan works for those of us who have regular jobs with regular employers. And one of the things that goes on is that these retirees, while they're working for the federal government, are making after-tax contributions that give them a basis in their annuities. And these documents that come out, these statements of annuities paid, show the amount of basis that they have in their plan, or at least the original amount of basis they had in the plan at the time that they retired. And in order for us as tax preparers to work with this information and figure out what portion of their distribution for the year is taxable, we need to fill out a worksheet called the Simplified Method Worksheet. So we're going to be taking a look at that next. So this illustration is showing us a typical format that is of document that is given to U.S. government retirees. We can see that this particular taxpayer had $1,800 of federal withholding, that the gross annuity amount is $13,900. This is her distribution. If she had a 1099-R, that would be the amount in box 1. But it isn't a 1099-R, it's something weird. Looks different. But it's the same type of idea, and you would treat it as if it was a 1099-R. It's just that it doesn't have box numbers that line up correctly. It also has state tax withheld. She's a resident of Oregon, and so she paid $400 of state tax. And then over here we have health insurance premiums, $900. That is money that could be deducted on Schedule A. That's what that's about. So original contributions, $40,000, gross annuity amount, $13,900. So we're going to have to see what we would do with that. There's also something referred to as the general rule, and I've never had to do the general rule. A couple of years I thought maybe I should learn about the general rule more and then I can teach people about it. So I printed the instructions for the general rule. I am not kidding you. It was like 150 pages long. So it's like I said, scratch that. I'm not going to teach you about the general rule. And the general rule is for a very small group of people, none of whom I've ever had to worry about preparing a tax return for. You can use the general rule to calculate the taxable part of your pension or annuity if the starting date is before November 19, 1996, but after July 1st, 1986. So you can see it's a pretty small group of people. And then you do not use the simplified general rule. So let's just suppose you had someone who fell in that group. Apparently you could still use the simplified general rule. You must use the general rule to calculate the taxable part of your pension or annuity if you receive your annuity from a non-qualified plan or a qualified plan if you are age 75 or older on the annuity starting date and your annuity payments are guaranteed for at least 5 years. Most of us use the simplified method, and I actually find it surprising how often I look at tax returns where I can see, I'm working with a client who's new to me this year, and I'm looking at their back year return, and I can see their preparer did not figure a simplified method worksheet, did not figure the tax-free portion of their distribution, and simply treated it as all taxable, which of course is a big error. Whenever you're looking at one of these annuity statements, and when someone comes in who was a federal retiree or is a federal retiree, their statements always look like this. So whenever you see a statement that looks like this, then you need to be thinking about the simplified general rule worksheet, the simplified method worksheet. And the worksheet is used to figure the tax-free part of each monthly annuity payment. And you figure that tax-free part by dividing your cost in the plan by the total number of expected monthly payments for your anticipated lifetime. Well, it's pretty hard for you to know how long you're going to live, right? We all hope we're going to be living for a long, long time, but the federal government has decided how long you're likely going to be getting retirement income based on your age at retirement. And so the worksheet actually shows that information. And what I've done here is I've filled out the simplified method worksheet for Sandy taxpayer for you so you can see how hers would work. And on line 1, we enter the gross distribution or gross annuity paid for the year, which is $13,900. And then the document itself told you that her cost in the plan was $40,000. Now there's some extra information here that I need to give you. Sandy taxpayer began taking distributions from her government annuity after retiring in 2008 at the age of 58. The amount she has recovered tax-free in earlier years is $3,971. Figure the taxable portion of her 2011 distributions is shown here. So one of the things we have to do is go down and look at this chart. There's 2 tables at the bottom. Table 1 for line 3 above, and Table 2 for line 3 above. And then it says, if your annuity starting date was before November 19, 1996, enter one of these numbers on line 3. And if your annuity starting date was after November 18, 1996, enter one of these numbers on line 3. Well, she retired in 2008, so that's definitely after 1996. And I told you she was 58 years old, so we look for her age. It's between 56 and 60. We follow that across, and that gives us 310, and we plunk that on line 3. Then underneath that, we see if the combined ages at annuity starting dates were these amounts. Well, this is if the annuity was for you and the life of your beneficiary, typically your spouse. So what was your age plus your spouse's age on the date you retired? And if you have a spouse who is a beneficiary of your annuity, then you would add your ages together on the retirement date and enter that number up here. But Sandy's single, we're going to enter 310 right here. The next step is to take 310 and divide that into the cost she has in the plan. And when we do that, we get $129.03. Then we look at how many months she received the annuity payments for this year. And, well, she was retired all year. She got 12 monthly payments. So we're going to say it's going to be 12 times 129. Most government retirees get 1 check a month. That's a pretty consistent thing. And that totals $1,548. So 129 times 310. Pardon me, 129 times 12 is $1,548. Now, I told you in the wording of the problem that the amount she has recovered tax-free in earlier years is $39.71. So that's something that has to get tracked over time. Each year you recover a certain amount tax-free, and you keep adding those prior year tax-free amounts up. And the amount recovered tax-free through 2010 was $39.71, and we put that on line 6. We're concerned with that because she's not going to be allowed to recover tax-free forever. If she lives to be 100, she's going to use up her tax-free allocations, and eventually it will all become taxable. But as we're sitting right now, she's only been retired for about 3 years. The amount she's recovered tax-free so far is $3,971. We're going to subtract that from $40,000, and that means right now her remaining basis that she can still recover tax-free is $36,029. She's allowed to claim the lesser of line 7 or line 5, and of course line 5 is the lesser amount. So we subtract line 5 from line 1, or pardon me, we subtract line 8 from line 1, and we enter the difference on line 9. And line 9 is, of course, the amount of annuity that she needs to pay tax on. That's going to carry to line 16D of the 1040. We then take line 6, add that to line 8, and enter the total on line 10. $5,519 is the amount she's recovered tax-free as of 2011, and we're going to take $5,519 and enter that on her 2012 86 or Simplified General Method worksheet, and it's going to go on line 6 next year. So this number will carry to next year's worksheet and get plunked there.
It is now time to complete the classwork assignments for Session 5. There are 2 classwork assignments today, and we'll take a look at classwork number 1 first. Classwork assignment number 1 is located on page 25 of your Session 5 student manual, and it is a relatively simple assignment to start the day with. And we have the forms needed to complete classwork number 1, one form only, Form 5329. Jane has purchased her first home. She withdrew money from her IRA to make the $20,000 down payment on her home 100 days before she purchased it. Jane's 1099-R is attached. Prepare her Form 5329. So at this point, please push pause on video playback. Complete Form 5329, and when you are ready, resume video playback for a review of the Session 5 Classwork 1 answer key. And I have up on the screen in front of you now the answer key for Session 5 Classwork number 1, a relatively simple assignment. We're simply asking you to determine the amount of penalty that Jane owes on her early distribution from her IRA. A key point to note is that this was a distribution from an IRA and not a pension or annuity plan, and therefore Jane is eligible to claim an exemption from some of the penalty. Now, the maximum amount of withdrawal that you can take from an IRA and claim an exception to the penalty on early withdrawal from an IRA is $10,000 in a year, and Jane actually withdrew $20,000. So even though all $20,000 was put down on her home, she will only be able to exclude $10,000 of the $20,000 from the early withdrawal penalty. So we will enter $20,000 of early distribution as a starting point on 5329, and then we will enter $10,000 as the amount that is accepted from the penalty. Let's go down to the form. We begin Form 5329 by entering Jane's name, and then on line 1 we enter the amount of early distribution that is included in her income. That's $20,000. Is any of that accepted from the penalty? Yes, $10,000 is, and the code that we use to indicate that $10,000 is accepted because it was spent on purchase of a first home is code 9. We enter code 9 and then enter 10 on line 2 as the amount that is not subjected to the penalty. 20 minus 10 is 10. That means $10,000 is still subjected to the penalty, and the penalty is 10%. We multiply 10% by $10,000, and we get a total on line 4 of $1,000. This concludes the review of the Session 5 Classwork 1 assignment. It is now time to take a look at Classwork Assignment number 2. Classwork Assignment number 2 involves preparation of a tax return with Form 1040, Form 8606, and Form 5329. This one's going to be a little bit more work for you. Jack, taxpayer, is age 50 and single. He took an early distribution from his traditional IRA during the year because he lost his job. His total cost basis in all IRAs for the year was $50,000, and he made no contribution to the account during 2011. Jack spent $2,000 for health insurance while he was unemployed, and he received the attached documents for the year. Go ahead and prepare his return. The first document that we see is Form 5498. It is used to show any contributions that he made to his IRA account during the year, and also the fair market value of the account at the end of the year. You can see that no contributions were made and that he had a year-end account amount of $100,000.
Jack also received this 1099-R showing that he distributed $20,000 from his IRA. The taxable amount is showing at $20,000, but then it's also checked that the taxable amount is not determined. There's really no way for this IRA management company to know whether all of the IRA distribution is taxable or not. That's why they've checked the box. Your job as a tax preparer is to determine how much of the $20,000 is taxable and prepare the tax return accordingly. And there we can see that the IRA simple box is checked. That tells us that this is an IRA distribution and not a regular pension distribution. We also have a W-2 for Jack in the amount of $30,000. So at this point, please push pause on video playback. Complete Jack taxpayer's tax return. When you are finished, please resume video playback for a review of the answer key. And I have the answer key for Classwork 2 for Session 5 up on the screen in front of you. If you would like to print a copy of the Session 5 Classwork answer keys, you can do so from inside the materials page for Session 5. And if you want to push pause and go print that and then come back, of course do that. Other than that, let's get on with the review. So let's take a look at the verbiage of the wording of the answer key first. And it says that Jack took a distribution from his traditional IRA. But since he has a basis in the IRA, he will need to complete Form 8606 to figure out what portion, if any, of the distribution is taxable. He is under age 59 and a half, and that means he is subject to an early distribution penalty unless he qualifies for an exception to the penalty. And it should be noted that IRA distributions that are used to pay for health insurance while he was unemployed are a qualifying exception. So we're going to have to do a 5329 to figure out how much penalty he doesn't need to pay because of the exception for health insurance premiums that were paid for during the time he was unemployed. We begin by completing 8606 for Jack to figure the taxable portion of his distribution and then finish with the rest of his tax return. On the simplest side of things, Jack is a single filer, and we're going to check the single box. We didn't give him any dependents and simply went on to line 7 where we entered his wage income. His wages are $30,000 as shown here on his W-2. We simply carry that over and enter it on the line. The next part of the form shows that he has a distribution from his IRA of $20,000. And we have calculated in our answer key that of the $20,000 that was distributed, $11,666 is taxable. So let's go to the 8606 and figure out how we determined that. So I now have on the screen in front of you both the Form 5498 and the 8606 at the same time because we're going to need to use these in conjunction with each other. The starting point for Form 8606 is to show the total basis that Jack had in all of his IRAs on the last day of the year. And we told you that in the wording of the problem. You can just see it sticking out right here. $50,000 is the basis that we gave you in all of his IRAs at the beginning of the year. And so we enter that on line 2. There are no additions to his basis during the year because he made no contributions. Jack made no contributions in 2011, and therefore his account is going to show 0 on line 1, 50 on line 2, and 50 on line 3. On line 6, we are asked to enter the total balance that was left in all of Jack's IRA accounts on the last day of the year. His year-end balance was $100,000 for his account. But that's after he withdrew $20,000 from his account. So really what we're interested in is that at the end of the year he had 100, but at the beginning of the year he would have had to have had more than 100 because he withdrew 20. So we're going to show the amount that he withdrew during the year, and we're going to add that to the amount that he had at the end of the year to get the total amount that must have been there at some point during the year, which is $120,000. The next step is to divide $50,000 by $120,000. And when we do that, we get 41.67%, or 0.4167. So essentially, the purpose of this exercise is to determine of the $50,000 basis that was in the IRA for the year, how much is going to be taxable. And we have to compare that to the total value of the account during the year. The total value of the account during the year was 120. His basis was 50. We need to know what percentage 50 is of that 120, and it is 41.67%. The next step is to multiply 4167 or 0.4167 by the distribution amount for the year, and that distribution amount is 20,000. So 20 times 41.67% is 8334. 8334 is the amount that Jack does not have to report as income on his tax return. This amount will not be reported on line 15B. We subtract 8334 from 20, and we get $11,666. $11,666 is the amount that is taxable and will be entered on line 15B of the Form 1040. So let's go back up to the 1040, and there we can see that we've entered $11,666. But we're not done. There was an early distribution from an IRA before the taxpayer reached age 59.5. That means a penalty is owed. So let's do the 5329. And we start 5329 not with the total amount of distribution for the year, but the total amount of taxable distribution for the year. That means you can't do 5329 until you've done 8606. So we do 8606 first, figure the amount of distribution from the IRA that's taxable, and enter that amount on line 1. Then, of the taxable amount of the distribution, is there any amount that will be accepted from the penalty? And the answer is yes. There was $2,000 of health insurance that was paid for while Jack was unemployed, and so that will qualify under exception code number 7. So on line 2, we enter code 7, the amount of money that was paid for health insurance while he was unemployed. We subtract $2,000 from $11,666, and we're left with $9,666 that is subjected to the penalty. The penalty is 10%, so we enter $967 on line 4. Now we need to carry the amount from line 4 to the second page, or page 2 of Form 1040, and you can see that we've entered that on line 58. So let's finish filling out Jack's tax return. On line 7, we enter $30,000 of wage income. On line 15B, we enter $11,666 of taxable pension. We total that income up, and on line 37, his adjusted gross income is $41,666. We carry that amount to line 38 and enter his standard deduction on line 40. The standard deduction for a single filer for 2011 is $5,800. We subtract that from line 38. We're left with $35,866. Next, we enter his exemption deduction of $3,700. We arrive at his taxable income of $32,166. The tax tables tell us that the tax on that is $4,401. We have no credits to offset it, so on line 55 we enter his tax at $4,401. We then, on line 58, need to enter the amount of penalty that he owes. $967 was figured on Form 5329. We add that to his other tax, and he's left with a total tax bill for the year of $5,368. The next step is to enter his withholdings. We've totaled those at $5,500 as follows. On his Form 1099-R, he has $4,000 of withholding in Box 4, and on his W-2, he has $1,500 of withholding in Box 2. $1,500 plus $4,000 is $5,500. We subtract $5,368 from $5,500, and we're left with $132. So that concludes the review of the Session 5 Classwork 2 answer key. It is now time to take a look at the homework assignment for Session 5. And the homework assignment for Session 5 involves preparation of a tax return for Betty Rebel. The forms you need to prepare are Form 1040 and Form 5329. Let's take a look. Betty will be filing married filing separate. Her husband, Barney, does not itemize his deductions. Betty resides in Plum, Texas, and during the year she received $1,500 of interest from her Port of Galveston bonds. She also cashed in and received $500 of interest on her Series EE savings bonds, which she used to pay for higher education. In February, Betty began full-time studies at Texas A&M University. She withdrew $4,000 from her IRA, of which she spent $3,000 on tuition and fees. Her 1099-R is attached. Betty was employed part-time, and her W-2 is attached to prepare her tax return. So she has a $9,000 W-2, a $4,000 pension distribution, 1099-R, and that is it. So this is the conclusion of Session 5 of the Basic Tax course. At the conclusion of this session, please complete the Session 5 homework assignment, enter your answers into the Session 5 assignments page, complete all reading assignments and other classwork and quiz assignments associated with this session. When you're all finished, you'll be ready for Session 6, and I will see you then. Bye-bye.